Hi, I'm John Prasinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, July 10. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. After a robust first half to 2023, the equity markets fell during the first week of the third quarter. During the July 4th shortened week, Wall Street was beset by renewed fears of inflation and prolonged hawkishness by the Federal Reserve. Odds are increasing that the Fed will hike rates again at the next policy-making meeting in late July. The equity rally took a breather, largely because of surprisingly strong employment and services data. Take a look at the following chart. For the week, the Dow Jones Industrial Average fell 2%, the S&P 500 fell 1.2%, and the technology-heavy NASDAQ fell 0.9%. The 10-year Treasury yield climbed to 4.06%. Crude oil prices jumped 4.3% for the week as OPEC Plus continues to tighten the spigot. That said, the bull case remains in place. Long-term investors, well, they're in a marathon, not a sprint. The resilience of the jobs market and the services sectors means that a recession probably isn't in the cards. Take a look at this chart. The S&P 500 index continues to hover above its 50 and 200-day moving averages. Moving averages identify the trend in the movement of a stock or index to determine support and resistance levels. The New York Stock Exchange Advanced Decline Line, the NIAD, also hovers above its 50 and 200-day moving averages. The NIAD shows how many stocks are advancing versus declining in any given period on the New York Stock Exchange. A rising NIAD is bullish because it denotes improving market breadth. So, despite losing steam lately, the stock market rally doesn't seem to be in serious jeopardy. To be sure, it's worrisome that the CBOE Volatility Index, the VIX, has edged higher in recent days, but it's still lower by over 25% year-to-date and continues to hover well below the threshold of 20. A reading of the VIX below 20 indicates less fear and stress in the market. A stronger-than-expected U.S. ADP private payrolls report released last Thursday drove bond yields higher as inflation worries returned. The private payrolls increase for June well exceeded consensus expectations, adding 497,000 jobs compared to forecasts for 225,000 jobs added. This is the highest level in over 1 year. But the ADP data was mitigated by a report released last Friday by the Bureau of Labor Statistics, which showed that the U.S. economy added 209,000 jobs last month, and the unemployment rate edged down to 3.6% from 3.7%. June's total, as reported by the BLS, was lower than May's unexpectedly robust showing of 306,000 jobs and below consensus expectations for a net gain of 225,000 jobs. It was the lowest monthly gain in jobs since decline in December 2020. Inflation fighters were pleased, but so were those worried about a recession. Amid these contradictory crosscurrents, the U.S. economy continues to hold its own. The latest Institute of Supply Management ISM data released last Thursday continue to show relative strength in services sectors compared to a contraction in manufacturing. The ISM Services Index for the month of June came in at 53.9 versus an expected 51.2 and above last month's 50.3 reading. Readings over 50 indicate expansion. Among the 18 services sectors, 15 expanded in June, including lodging and food services and entertainment and recreation, building the case for an ongoing demand for services broadly. At the same time, the ISM manufacturing component continues to show weakness. Keep in mind, though, that services account for over 75% of the overall U.S. economy. In the bond market, Treasury yields have climbed higher as expectations grow that the Fed won't pause its tightening cycle again in July. Both the 10-year and 2-year yields have moved toward their highs of 2023, with the 10-year above 4% and the 2-year near 5%. This trend has weighed on bond prices, as well as on growth-oriented equity sectors that are sensitive to interest rates. Now let's take a look at the week ahead. The following economic reports, scheduled for release in the coming days, bear especially close scrutiny and have the power to move markets. Wholesale inventories Monday, NFIB Optimism Index Tuesday, Consumer Price Index and Fed Beige Book Wednesday, Initial Jobless Claims Producer Price Index Thursday, and Consumer Sentiment on Friday. The big news this week, of course, will be the two inflation reports, which analysts expect to show a further cooling of prices. Despite last week's decline in equities, I'm still convinced that we're laying the foundation for a sustained market recovery in the latter half of 2023. However, if you're spooked by some of the risks I've just described, consider the advice of my colleague, Jim Pierce. Jim Pierce is the chief investment strategist of our flagship publication, Personal Finance. Jim has found the optimal way to cash in on the artificial intelligence superboom. It's an obscure picks and shovels play that you won't hear about on CNBC. Jim's AI investment lets you get started for about $100, and it generates regular cash payouts of up to $5,397. Want to learn more? Click the URL at the bottom of the article that accompanies this video on the Investing Daily website. And if you have any comments or questions, please don't hesitate to send an email to me at mailbag@investingdaily.com. Well, that's it for now. Thanks so much for watching.